This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 29, 2026, and this is the New York pre-market. Now, let's get into it. We are staring down a structural paradox in crypto markets today. Total market capitalization has expanded by plus 1.36%, yet the fear and greed index is buried at 14 out of 100, deep in extreme fear. Bitcoin is holding above $64,000, but futures demand has collapsed to its lowest levels since early 2024. We have price stability without leverage and sentiment that refuses to budge. Looking ahead, the economic calendar carries significant weight for the broader financial landscape. First, the FOMC rate decision drops later today on July 29th. Any commentary on rate trajectories will directly influence the risk appetite for speculative assets like Bitcoin and Ethereum. Then, on July 30th, we see a triple header of data: gross domestic product readings, initial jobless claims, and the PCE price index alongside personal income figures. For crypto, these metrics serve as the primary gauge for institutional liquidity conditions. As the market digests today's FOMC outcome, Apex, what is the single metric watching for?
I'm watching the divergence between the spot price action and the open interest in futures. If the FOMC signals tighter than expected liquidity, the current drop in Bitcoin futures demand to 2024 lows could accelerate. We need to see if spot buyers can hold the line without institutional leverage supporting the bid.
That sets the stage. Let's look at the data as it stands right now. As of 9:19 Eastern Time on July 29, 2266, Bitcoin trades at $64,255, up 1.30%. Ethereum is at $1,903.39, up 1.60%. The broader market cap sits at $2.275 trillion. But beneath the surface, the dynamic is fractured. Bitcoin dominance holds at 56.61%, while the SIBO VIX sits at 18.67, signaling calm in traditional equities despite the terror in crypto sentiment. Pulse, walk us through that fear and greed reading. Is 14 really the floor?
14 is not just a number, it is a psychological wall. The index has stabilized marginally, rising from 12 on the 7-day trend, but it remains firmly in the extreme fear zone. What is striking here is the dissonance. Normally, a 13% market cap expansion would trigger greed. Instead, we see a classic accumulation divergence where spot prices are ticking up while crowd psychology remains terrified. This isn't panic selling anymore, it's numbness. And numbness is often a precursor to either a slow grind higher or a sudden, unexpected capitulation if a catalyst breaks the status quo.
And that numbness is dangerous precisely because it masks the risk. Look at the VIX. It is sitting at 18.67, well within its 5-day range of 16.64 to 20.31. Equities are complacent. Crypto is screaming in pain. That disconnect means we are pricing in idiosyncratic risks, geopolitical shocks, regulatory overhangs, that the broader market is ignoring. When those two datasets finally reconcile, usually via a volatility spike, the lack of futures leverage Bitcoin currently enjoys means there is no cushion to absorb the sell-off.
Speaking of regulatory overhangs and geopolitical shocks, let's look at the headlines shaping this environment. First, Cointelegraph reports, Iranian crypto outflows spike 700% after U.S.-Israeli airstrikes. Second, CoinDesk notes, U.S. Senate housing bill includes CBDC ban. Third, Cointelegraph highlights, Bitcoin futures demand falls to 2024 lows. Are institutions exiting the market? CIPHER. Start with the geopolitical angle. How is the Iranian outflow impacting global flows?
It is injecting a pure geopolitical risk premium into the ecosystem. A 700% spike in outflows from Iran following airstrikes suggests that capital flight dynamics are accelerating in regions facing conflict. This drives volume into stablecoins and privacy-focused assets as users seek exit ramps outside traditional banking rails. However, this volume is largely reactive and defensive. It explains some of the spot liquidity supporting assets like XRP and Tron, but it does not indicate institutional conviction. In fact, it underscores why large-scale institutional players might be hoarding cash. They are seeing fragmented, chaotic flows rather than clean, structured entries.
So this is retail or regional survivalism, not Wall Street entry. Now, the CBDC ban headline. Grid, how does the Senate Housing Bill's inclusion of a CBDC ban affect the technical structure for Cardano and XRP?
It provides a clear narrative tailwind for both Cardano and XRP. We are seeing Cardano trade at 16 cents with a 4.40% gain, and XRP holding at $1.08 with a 2.8% rise. Technically, both assets are establishing relative strength against the broader market's paralysis. Cardano has formed a consolidation pattern near the 16-cent level that respects support, while XRP is grinding higher against a stagnant Bitcoin. This isn't necessarily a breakout yet, but it is a rotation of capital toward assets perceived as having regulatory moats. The ban narrative reinforces the value proposition of decentralized ledgers over centralized alternatives, keeping buy-side interest localized to these specific names.
Be careful calling it a moat. I challenge grid interpretation of this as organic demand. Look at the laggards. NEAR is down 4.4%, Litecoin is down 2.8%. The capital flowing into Cardano and XRP is largely being rotated out of weaker midcaps and legacy coins, not brought in from the sidelines. With Bitcoin dominance holding at 56%, this is a zero-sum game within the existing pool. Once the novelty of the legislative news fades, without fresh liquidity from the collapsed futures market, these safe haven assets could revert rapidly.
Let's drill into Bitcoin specifically. It is at $64,255, up 1.30%. The core tension is price stability versus vanished leverage. Grid, give me the technical posture.
The chart is neutral to consolidative. Bitcoin is respecting the 64,000 area as immediate support, testing the upper bound of the recent range near 6466. However, the lack of volume expansion tells the story. Without the fuel of open interest growth, the path of least resistance remains choppy. We are seeing a series of higher lows on the hourly charts, but they are shallow. The structure is intact but fragile.
And that fragility is confirmed by the flows. Bitcoin futures demand is at 2024 lows. Institutions are not leveraging up on this dip. They are sitting on their hands. Meanwhile, spot ETF flows are steady but not explosive. We are seeing a vacuum. The price is held up by passive buy orders and short covering squeezes, not genuine aggressive buying. If the spot market absorbs all available sell pressure at these levels, we might see a sticky base, but any sudden influx of sell-side volume will find very little bid depth above.
Exactly. And look at the sentiment data. The fear and greed index is at 14. Retail traders are not fear of missing outing in. They are scared to touch the asset. So who is buying? Likely algorithmic market makers providing liquidity and patient accumulators scaling in slowly. But the emotional driver, the greed part of the equation, is completely absent. You cannot sustain a bull market on market maker liquidity alone for long.
Which brings us back to the VIX. At 18.67, equities are sleeping, but crypto is awake and terrified. If the VIX spikes even modestly in response to the FOMC decision later today, Bitcoin could face a correlated liquidation event. There is no leverage buffer to stop the bleed. We saw similar dynamics in late 2023 where spot prices drifted sideways while funding rates turned negative. If that happens here, the downside correction could be swift and disconnected from fundamentals.
So the risk is asymmetric. Upside requires a return of leverage, downside needs only a macro jolt. Moving to Ethereum. Ethereum is at $1,903.39, up 1.60%. It is outperforming Bitcoin percentage-wise. CIPHER, flows are shifting here.
Yes, while Bitcoin dominance is static at 56%, we are seeing concentration in decentralized finance protocols. Uniswap, for instance, is up 5.90%. This suggests capital is rotating into the infrastructure layer of Ethereum rather than just holding Ethereum. The PayPay IPO narrative, where PayPay, owning 40% of Binance Japan, seeks up to $1,100 million in a Nasdaq listing, is also creating a halo effect for compliance-friendly ecosystems. Institutional capital seems to prefer the regulatory clarity offered by major decentralized finance hubs over the wild west of alt speculation.
Technically, Ethereum is forming a tight ascending channel against Bitcoin. The key level to watch is 1,925, the 24-hour high. If it clears that with volume, the relative strength becomes undeniable. Currently, it is hovering near 1,925, resisting resistance. The EMI cluster suggests a mild bullish bias, but it is tethered to Bitcoin's broader indecision. It won't sprint unless Bitcoin gives permission.
Sentimentally, Ethereum feels less hated than Bitcoin right now. The community narrative has shifted towards infrastructure value thanks to the tokenization headlines from TD Securities and Bitfinex. People are tired of the speculation. They want the yield. That shift in sentiment, from hoping for price appreciation to seeking utility, is reflected in the steady, non-volatile gains of Ethereum compared to the erratic swings of smaller caps.
Don't mistake steady for safe. The 24-hour low for Ethereum was $1,867. It bounced, yes, but look at the broader market cap change, 1.36%. That is barely covering the noise. If the EFF-OMC announcement triggers a risk-off event in treasuries, Ethereum, as the second largest risk asset, will lead the decline faster than Bitcoin. Its liquidity is deeper, but so is the potential damage.
A valid caution. Let's look at the standout performers. ADAUSD is leading the pack, up 5.90% to $4.04. Why is it moving?
It is breaking out of a multi-week accumulation zone. The $4 level acted as initial resistance, but today's move above it on increased volume suggests a breakout attempt. The relative strength is evident. While Bitcoin chops, Uniswap is trending up. The structure supports a test of the previous local highs, provided volume sustains above the $80 million daily average.
Because of the tokenization narrative, TD Securities identified NYSE tokenization as an institutional turning point. Uniswap is the prime beneficiary of on-chain settlement for institutional-grade assets. The flow data shows a steady inbound movement into Uniswap's liquidity pools, distinct from the speculative wash trading we see elsewhere. This is smart money positioning for the tokenized bond future mentioned in the Bitfinex revival headline.
The sentiment here is cautiously optimistic. Unlike the fear surrounding Bitcoin, Uniswap holders are celebrating the regulatory wins. The CBDC ban makes decentralized exchanges more attractive politically. The community tone is supportive, viewing Uniswap as a beta play on the entire tokenization sector. It's a morale booster for the decentralized finance space.
Or it's a bubble waiting to pop. 5.90% is a huge move for a mid-cap asset in a fear-driven market. If the broader market turns south, Uniswap will suffer the most due to its high beta. Also, consider the liquidity depth. If large institutions enter, they might find slippage issues at these levels. The upside is limited by the thin order books typical for governance tokens post-airdrop. I'd treat this as a technical trade, not a foundational hold.
Finally, let's address the regulatory favorites. Cardano is up 4.40% to 16 cents, and XRP is up 2.8% to $1.08. Grid, are these sustainable trends?
Both are showing strong relative performance. Cardano is holding above the 15-cent support level, creating a clearer path to the 17th cent. XRP is consolidating just below the $1.10 mark. The common thread is the CBDC ban narrative. These assets have benefited from a specific political storyline. Technically, they are decoupling from Bitcoin's stagnation. If Bitcoin holds the 64,000 level, these two could continue their outperformance. If Bitcoin breaks, they will likely fall with it, albeit slower.
The flows confirm it. Money is leaving speculative NEFT projects and migrating to these established chains with proven transaction histories. It's a flight to quality within the crypto ecosystem. However, remember the futures data. Open interest on Cardano and XRP is not exploding. This is spot-driven strength. Spot strength is good, but it lacks the explosive potential of leveraged longs.
Sentiment-wise, the community is divided. Some see the regulatory clarity as vindication, others see it as a narrow window that could close. The extreme fear index means the broader market is not participating in this rally. It's a niche victory, not a market-wide celebration.
My concern is the reverse correlation. If the Senate bill stalls or faces amendment, the narrative collapses instantly. These pumps are news-dependent. Once the headline cycle moves on, the liquidity dries up. Keep your stops tight.
We've covered the major movers. Apex tie it all together. We have price stability, collapsed leverage, and divergent sector narratives.
Here is the synthesis. Pulse highlighted the numbness in the fear and greed index at 14, a sign that panic has exhausted itself, but hope hasn't arrived. Grid confirmed that technical structures for Cardano and XRP are resilient, relying on narrative strength rather than broad market momentum. CIPHER revealed that capital is rotating into decentralized finance infrastructure like Uniswap, driven by institutional tokenization trends, while fleeing speculative alts. SPECTER correctly warned that the VIX stability at 18.67 hides a massive risk. If that equilibrium breaks, the lack of Bitcoin futures leverage leaves the market exposed to a sharp downside correction. The takeaway is that we are in a hold and wait phase. Accumulate regulatory beneficiaries on dips, avoid legacy coins like LTC, and watch Bitcoin futures open interest for the first sign of institutional re-engagement.
To summarize, Bitcoin is stabilizing at $64,255, but with zero leverage support. Ethereum and Uniswap are benefiting from a structural shift toward tokenized assets and regulatory clarity. Extreme fear persists at 14, but price action refuses to break lower. Tomorrow, watch the EFF-OMC decision and the subsequent reaction in Bitcoin futures open interest. If leverage returns, we have a floor. If it doesn't, we may be walking a tightrope. This has been ShadowQuant Crypto Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.